Paytm, a fintech giant with investment from Chinese Alibaba Group and Japanese SoftBank, is building a financial services model on top of its payment business. This 11-year-old company, which is still making losses, was last valued at $16 billion by private investor. The IPO listing is expected to give a massive valuation of $24 to $13 billion, which is more than 50 times the revenue of the company. Globally, the payment companies are valued at less than 25 times of their revenues. The big question is how Paytm business will move from low-margin payment business to highly competitive lending, investment, wealth management, and insurance. How does his journey move from a private company to a publicly listed company where profitability guidance matter a lot? What will be the key valuation drivers or the high margin business for Paytm to reward shareholders in the years to come? And finally, should you bet your hard-earned money in a loss-making company where the founder, Vijay Shekhar Sharma, owns less than 15% stake and is no longer classified as a promoter? Let's find answers to all these questions. Paytm is mirroring the Chinese Alipay model, which transformed from a digital wallet company to a lifestyle player, which includes taxi, hotel, and movie ticket bookings, payment of utility bills, investments, wealth management, and even helping in appointments with doctors. The Paytm's bulk of the revenue today comes from the payment services, which is a cash burn business because of cashbacks and other goodies. The other businesses like lending, investment, insurance are very small today. In the payments business, Paytm has built a large network of merchant acquisition by providing QR codes, POS solutions, and payment gateway for digital transaction. Paytm earns a transaction fees from its merchant based on the percentage of the gross merchandise value. It also gets recurring subscription fees from merchant for payment soundbox and POS terminal. There are also consumer convenience fees and other sources. Payments is a customer acquisition channel for the company to push through multiple products. Clearly, the key is data analytics and monetization of data by cross-selling and building a model on top of payments. But the competition is coming from the government, which is creating payment platforms like UPI, Bharat Bill Payments, which is available to everyone. Today, Google Pay and PhonePe have emerged as big players in the small payments business. The real value for Paytm will come from the lending business, where the margins are much higher. The company is already into lending products like buy now, pay later, and credit card business. But the company is currently not lending from its book. As a lead generator, its margin may have been better than the distributor, but nowhere near to the banks and the NBFCs, which lend from their own book. Paytm doesn't provide the lending revenues, but the revenue from the financial services are 75% of its total revenues, where 25% of the revenue comes from commerce and cloud business. The next logical step for Paytm would be taking the direct exposure. But for this, the company needs a full-scale banking license. Paytm Payments Bank, which accepts deposit but not allowed to lend, is already considering conversion into a small finance bank next year. But there are also risks if payments start lending from its balance sheet tomorrow. The risks in lending are very high in the underserved segment or small ticket size loans. Paytm Money is the investment and wealth advisory arm, which is creating an online platform for investors to do equity, futures and option, mutual fund, SIPs, NPS, and wealth management. This company is up against new age players like Zerodha, Upstock, and 5paisa, which have built a lending model of margin trading after attracting customers in their zero brokerage platforms. Paytm Insurance Broking is an aggregator of insurance product from auto to health. But margin in an aggregator business is a big issue. There are also pure play digital models like Digit and Acco Insurance backed by serious investor for an altogether new experience of paperless insurance. The IPO will also test Paytm's high valuation. The private market value a business model on its customer base, network, and potential scale. This is actually built in the current valuation of Paytm, at which it raised capital in the private market from Alibaba and SoftBank. The public market will give higher importance to break-even guidance and a path to sustainable, profitable business model. The IPO will certainly put a lot of pressure on Paytm to give a guidance on the path to profitability. There is also a promoter risk. The founder Sharma, who is the brain behind the rise of Paytm, is no longer identified as a promoter because of his low stake. at 14.8%. Given the investment requirement in future, there is every possibility of Sharma's stake falling to a single digit in the near future. Paytm's board with global investors has all the powers to take critical decisions about the company, and not founder Sharma, who is also the MD and CEO. The powers like raising debt, creation and operation of subsidiaries, approval of a business plan, intercompany financial transaction above a certain monetary threshold, and appointment and removal of key management team will now be with the board. Clearly, there are many known unknowns in the Paytm IPO.